Estate tax is a transfer tax triggered at death. It's not an income tax. On the EA exam, they'll test that separation. Form 706 is for the estate tax, while Form 1041 is for the estate's income during administration. Same family of rules, different tax base. Estate tax looks at what the decedent owned and controlled, valued at fair market value on the date of death. Form 706 is required when the gross estate plus adjusted taxable gifts exceeds the filing threshold. For 2024, the basic exclusion amount is $13.61 million. And remember portability. If the executor wants to transfer a deceased spouse's unused exclusion, they file Form 706 even if the estate is under the threshold. That's a classic exam trap. Filing can be required for D-SU-E, not just tax due. Now, build the gross estate. Start with fair market value, not what the decedent paid. Include all property owned outright or partially at death, tangible and intangible. Add life insurance proceeds if payable to the estate, or if the decedent owned the policy and it's payable to heirs. Add certain annuities or survivor benefits, and watch the 3-year rule. Some transfers close to death get pulled back in. Equally important, what's not in the gross estate. Property owned solely by a spouse or someone else is not included just because they're related, and completed lifetime gifts generally stay out, meaning the transfer was complete and irrevocable with no retained control. On the EA exam, the word retained is your red flag. If the decedent kept strings attached, it may come back into the estate. After gross estate, subtract allowable deductions to reach the taxable estate. Common deductions, funeral expenses, administration expenses, and debts at death. Then the big two: the marital deduction for property passing to a U.S. citizen spouse, and the charitable deduction for qualifying charities. You can also deduct state death taxes. These deductions are where the exam likes to test allowed versus disallowed. A few deductions are specifically disallowed. Federal estate tax paid is not a deduction from the gross estate. Alimony paid after death isn't a deduction either. It's treated like a beneficiary distribution. And property taxes are only deductible if they accrued under state law before death. That last one is sneaky. The timing of accrual matters, not when the bill is paid. Deadlines are pure memorization points. Form 706 is due 9 months after the date of death, and the tax is due then too. You can request a 6-month extension using Form 4768, but that's an extension of time to file, not automatically an extension to pay. On the exam, if they give you a date of death, count forward 9 months. No shortcuts. Mateo has a loss from worthless securities. How many years does he have to amend his tax returns in order to take this loss? The choices include 2 years, 7 years, 6 years, or 3 years. Think about it. This is one of those statute of limitations exceptions. The correct answer is 7 years. Refund claims attributable to worthless securities get a special 7-year period, which overrides the usual 3-year rule you're used to seeing. 3 years is the tempting answer because it's the general refund claim statute, but worthless securities are a tested exception. Before her death on January 1st, Natalie ran a custom dressmaking shop using the cash method. A vendor owed her $20,000 for a dress she made, but the vendor paid on March 1st, after Natalie died. The check was made to the estate, and the money was not distributed to her son, Ethan, before the estate settled. Where is the $20,000 reported? The estate's Form 1041, Ethan's Form 1040, split between returns, or Natalie's final Form 1040? Think about it. Reported on the estate's Form 1041. This is income in respect of a decedent, earned before death but received after death, so it does not go on Natalie's final Form 1040. IRD is taxed to whoever actually receives it. Here, the estate received it and didn't distribute it to Ethan before settlement, so the estate reports it.